Welcome back. Now, you all know that a company receives its funds from the long-term loans and the shareholders' equity, for which it has to pay interest and dividend. So whenever these funds are invested elsewhere, the profit that they get from these investments or the return on capital employed should definitely be greater than this cost. Only then the company will be able to pay this interest and dividend. So this is a crucial thing that every company has to follow. The return on capital employed or the profits that they get from the investments should be greater than the cost of capital. Now, the returns or the profits should not be just sufficient for payment of interest and dividends. We need a little more extra. Why is this extra required? This extra is required for meeting the corporate expansion needs, for paying taxes, etc. So a company always fixes a target rate. Now, this target rate will always be greater than this cost of capital. And for every investment opportunity, the company will ensure that the return on capital employed is greater than this target rate. Now, in this method, always bear in mind that we always evaluate based on the profits and not on the basis of cash flows. Now, this profits requires a bit of explanation. So we will take a look at the pro forma income statement or the profit and loss account. So the first item, you have the sales. From the sales, you reduce the cash expenses, assuming that all expenses are in cash. And then there is one major non-cash expenditure, that is depreciation. The resulting figure is EBIT. EBIT is earnings before interest and tax. It is also known by the name operating profit. From that, you reduce interest to get the profit before tax, reduce tax to get the profit after tax. Now, whenever we are calculating the return on capital employed, we have to use the EBIT, that is the earnings before interest and tax or the operating profit. Now, let's take a look at the formulas. So for return on capital employed method, also known as the accounting rate of return, we have got two formulas. One using the initial capital and the second one using the average capital. So using initial capital, the return on capital employed is equal to average annual EBIT. EBIT is nothing but earnings before interest and tax divided by initial capital into 100. Simple. That is, if your profit is 10 and the capital that you have invested is 100, then it means that your return on capital employed is 10%. So that is the meaning of this formula, average annual EBIT divided by initial capital into 100. Now, if you're using average capital, the only difference is that instead of using the initial capital, you use average capital. That's it. So the formula gets modified. It's average annual EBIT. The numerator remains same. And the denominator, you are calculating the average capital. And the average capital is given by the formula initial investment plus the scrap value divided by 2, which means that if you're starting with an initial investment of 100 and the final scrap value is 50, then on an average, the capital that is employed is 100 plus 50 divided by 2, or it is equal to 75. Now, for return on capital employed, you might have a confusion whether we should use the first formula, that is using the initial capital, or we should use the second formula using the average capital. The answer is quite simple. If you have to use the average capital, it will be specified in the question. If the question is silent, then we can very safely use the first formula, that is using the initial capital. Now, coming to the numerator, we need the EBIT. EBIT will never be directly given in the question. It will be cash flows that will be given. So how do we derive EBIT from the cash flows? Let's take a look at the pro forma income statement. Now, look at this very carefully. Assuming that all the sales is done on a cash basis, and these are definitely cash expenses. Now, depreciation is a non-cash expenditure, and interest, assuming this is also cash basis, and tax paid, this is also cash basis, which means that the profit after tax is actually the net cash flows minus the depreciation, because depreciation is the only non-cash item in this statement. Now, in many of the questions, this interest and tax will be absent. They will not give it, which means that the EBIT and the profit after tax will be the same, because the intermediary figures that we are reducing, that's the interest and the tax, are absent. So since the EBIT and the profit after tax is the same, the formula for EBIT can be written as cash flows minus depreciation. Now, depreciation is calculated based on straight line method. So under straight line method, how do we calculate depreciation? It is the asset cost minus the scrap value divided by useful life. Now, the formula was average annual EBIT. It was not just EBIT alone. So in order to calculate the average annual EBIT, you have to just take the average cash flows, because the cash flows will be like given as year 1 cash flow, year 2 cash flow, year 3 cash flow, etc. So how do you find out the average cash flows? Simple. You have to just add all the cash flows and divide it by the number of years. So in short, in order to calculate the average annual EBIT, you have to take the average cash flows minus the depreciation. Depreciation formula is asset cost minus scrap value divided by useful life, because the straight line method of depreciation is adopted. And for average cash flows, you have to adopt the formula sigma cash flows. That is, you have to add all the cash flows divided by the number of years. Question number 1. A project involves purchase of a plant costing 110,000. So this is the initial investment. It would generate annual cash flows of $24,400 for 5 years starting in year 1. The plant purchased would have a scrap value of $10,000 in 5 years' time when the project terminates. Determine the project's return on capital employed using initial capital cost. So return on capital employed using the initial capital cost is given by the formula average annual EBIT divided by initial capital into 100. And what is this average annual EBIT? That is equal to the average cash flows minus the depreciation per annum. And what is this average cash flows? It is given by sigma cash flows. That is a sum of all the cash flows divided by the number of years minus the depreciation per annum. And what is depreciation? Based on the straight line method, it is the asset cost minus the scrap value divided by the useful life. So we have got all the formulas in place. So we will first tackle the average annual EBIT. The first item, what is the average cash flows? So if you read the sentence, it would generate annual cash flows of 24,400 for 5 years, which means that the cash flows are constant. So even if you adopt this formula, that is sigma cash flows, that is the total of cash flows, it is basically 24,400 into 5 years. And again, we have to divide it by the number of years, which is again 5. So we are left with the very same amount of 24,400. So whenever we are having constant cash flows, basically we don't need to adopt this formula. We have to just take this figure 24,400, because that is the average cash flows per annum. So we've got the first item, 24,400. Now coming to depreciation per annum. What is the asset cost? The asset cost is 110,000. The scrap value, they have said it is $10,000. And the useful life, they have said it is 5 years. So substituting these figures in the formula, we get
110,000 minus 10,000 divided by 5, which is equal to $20,000 per annum. So the average annual comes to 4,400. So we've got the numerator, that's the average annual EBIT. And what is the initial capital? Initial capital is $110,000. So substituting those figures, we get 4,400, which is the average annual EBIT, divided by initial capital, that's 110,000, multiplied by 100, you get the return on capital employed as 4%. So that's the final answer. Moving to question number 2, a project requires an initial investment of $800,000 and earns net cash inflows as follows. So you're given years from 1 to 7, and these are the cash flows. So please note that these are not constant cash flows. The cash flows are varying from year to year. In addition, at the end of the 7-year project, the assets initially purchased will be sold for $100,000. So this is basically the scrap value. Determine the project's return on capital employed using the initial capital cost and the average capital investment. So we will first tackle part A, that is calculating return on capital employed using initial capital. So the formula for return on capital employed using the initial capital is average annual EBIT divided by initial capital into 100. And average annual EBIT is given by the formula average cash flows minus depreciation per annum. And average cash flows is nothing but sigma cash flows, that's the total of the cash flows, divided by number of years. And as for depreciation, adopting the straight line method, it is the asset cost minus the scrap value divided by the useful life. So we will first calculate the average cash flows, that is sigma cash flows divided by number of years. So if you total all the cash flows, that is sigma cash flows, you will get an amount of 1,750,000 or $1.75 million. And what is the number of years? The number of years is 7. So divided by 7, you get the average cash flows as $250,000. Now coming to depreciation. What is the asset cost? The asset cost is 800,000 and the scrap value is 100,000 and the useful life is 7 years. So the depreciation per annum comes to 800,000 minus 100,000 divided by 7 or 100,000. So the average annual EBIT is 250,000 minus 100,000, that's 150,000. So we have got the numerator and the initial capital, we know it's 800,000. So substituting those figures, we get 150,000 divided by 800,000 into 100, or the return on capital employed is 18.75%. Now moving to part B, that is calculating return on capital employed based on the average capital. Now the numerator remains the same. It remains at $150,000. It is only the denominator. We have to substitute average capital instead of initial capital. So please take note of the numerator. It's $150,000. So part B, return on capital employed using the average capital investment. All that I have done is in the denominator, I have substituted average capital. And average annual EBIT, 150,000, I said, we have already calculated it. So we have to just copy it from part A. Now coming to average capital, the formula for average capital is initial investment plus the scrap value divided by 2. The initial investment is $800,000. The scrap value is 100,000 divided by 2. So we get 800 plus 100,000 divided by 2 or $450,000. Please. So substituting 450,000 in the formula, we get return on capital employed as 33.33%. Now a common doubt that is asked by students for this problem is, while calculating the average capital employed, what is the formula that was adopted? It is initial investment plus the scrap value divided by 2. But while calculating the average cash flows, what was the formula that was used? Sum of all cash flows divided by the number of years for which the cash flows have been taken. So for average capital, why can't we adopt the very same logic and adopt this formula, that is sum of capital employed divided by the number of years for which the capital has been taken. Just like we have calculated the average cash flows. Why is there a difference in the formulas? This is the question.
So just to clear your doubt, what we will do is we will write the capital employed of all the years, and then we will apply this formula and see the result. So please take note of this point. Depreciation per annum is 100,000. So you're starting with an initial investment of 800,000, which means that each year the investment will get reduced because of the depreciation of $100,000. So this is the capital employed for each year. The initial investment is $800,000. And for each year, there is a reduction of 100,000. That is nothing but the depreciation. And then you are left with 100,000. That is the scrap value at the end of year 7. So this is the table of capital employed for all the years. So if you were to adopt this formula, that is sum of capital employed, then the sum of all these capital employed is 3,600. And how many capital employed figures have we taken? It is 7 years plus the initial investment. So which means that 8 total capital employed figures that we have taken is 8. So sigma of capital employed is 3,600 and number of years for which the capital is taken is 8. So substituting those figures, we get 3,600 divided by 8. That's the number of years. So we get the very same answer of $450,000. So this is the reason why we are not adopting this formula, sum of capital employed divided by number of years of capital taken, because we end up with the same answer, because the only reduction that is taking place is the depreciation. So we can very safely take this formula instead of this long formula, that is adding all the capital employed, dividing it by the number of years for which the capital is taken to find out the average capital. That's just not required. Now let's see the advantages and disadvantages of the return on capital employed method. So there are mainly 2 advantages. One is simplicity. You have seen that return on capital employed is very simple. Now another advantage is it could be linked with other accounting measures. Now we know the formula of return on capital employed. What is it? Return on capital employed is given by the formula EBIT divided by capital employed. We can actually split that ratio into 2. One is operating profit ratio, that is given by EBIT divided by sales, multiplied by asset turnover ratio, that's sales divided by capital employed. Sales and sales get knocked off. So which means that return on capital employed can be further analyzed as the operating profit ratio and the asset turnover ratio. What is operating profit ratio? It is how much profit we are making on the sales. That is for each dollar of sales, what is the profit that we are making? And what is asset turnover ratio? How much of sales is being generated for each dollar of capital employed. So since return on capital employed is profit-based, we can always link it to other accounting measures. It is not cash flow based. Now we have to see the disadvantages of the return on capital employed method. Now, before we take up the disadvantages, we will do a small illustration so that the disadvantages will be much more clearer.
Suppose there is this investment opportunity where you can buy a machinery worth $100 and its useful life is 2 years and the scrap value is nil. Earnings before interest and tax that you get on a yearly basis is $9. Now let's work out the return on capital employed for this investment opportunity. So return on capital employed using the initial capital works out to 9, which is nothing but the average annual EBIT. The initial capital is $100. So the return on capital employed works out to 9%. Now, if we were to calculate return on capital employed based on average capital, then the average capital works out to $100. That's the initial investment plus the scrap value of 0 divided by 2. So on an average, the capital employed is 50. So substituting 50 in this formula, you get the return on capital employed as 9, which is the average annual EBIT, divided by 50 into 100, which works out to 18%. Just because we've taken the average capital, the return on capital employed increased. Why? because the denominator had reduced because of the impact of depreciation. See, the asset value depreciated to 0. So on an average, when we calculated, the average capital reduced to 50. That is a reason for this increase in the return on capital employed. Whenever depreciation is involved, the return on capital employed increases. So now let's look into the disadvantages. The first main disadvantage is it varies depending on accounting policies. Now we know that return on capital employed is based on EBIT. That is a profit-based investment appraisal technique. We know that profit differs based on the accounting policies adopted. For depreciation, we have the straight line method, we have the written down value method. Likewise, depending on the accounting policies, the profit may vary. So that's the first disadvantage. And the second disadvantage is it ignores the time value of money. Again, since this is profit-based and we are not taking into consideration the cash flows. If you see here, earnings before interest and tax is after reducing depreciation, which is a non-cash expenditure. So we are not worried about the cash flows. The timing of cash flows is very important for any organization. And return on capital employed improves for depreciated assets. This is what we have seen. When we adopted the average capital, immediately the return on capital jumped to 18% without any increase in the return. It is just because a reduced denominator had been taken because of the impact of depreciation that we got an increased return percentage, not because the EBIT had actually increased. Now, before we wind up, I would like to add a fine point. The formula for average annual EBIT is average cash flows minus the depreciation per annum. This formula holds good when there is no interest or tax in the question. Now, suppose if in the question, the tax and the interest is also given, then how would you arrive at the EBIT? Now, whenever we reduce the depreciation from the average cash flows, what you're getting is profit after tax. That is, we are here. Now, profit after tax and the EBIT will remain same only when interest and tax is absent. If tax and interest is mentioned in the question, then from the profit after tax, if you have to arrive at the earnings before interest and tax, then the adjustment that you have to do is, now if tax is say 20%, it is mentioned in the question that the tax is 20%, which means that if this is 100, then 100 minus 20, 80% is the profit after tax. So if this is profit after tax, when you're adding back the tax, because in order to arrive at the EBIT, we have to add back tax, we have to add back interest, right? So in order to add back tax, say at the rate of 20%, what you have to do is profit after tax is equivalent to 80%. So profit after tax divided by 80 into 20 will give you the tax figure. So this is the adjustment that you have to do. And further, you have to add back interest also. So you add back interest to finally arrive at the EBIT or the operating profit. So always note that this adjustment has to be done only when the tax and the interest is given in the question. Because for all calculations of return on capital employed, the figure that we have to take is the EBIT or the earnings before interest and tax.